But the company on our radar right now is Deepak Fertilizer. They've posted a mixed set of earnings. While the revenue growth has come in at 40% on a year-on-year basis, margins have contracted to around 17% versus the earlier level of 25%. We're now joined by Mr. Asif Mehta, the Chairman, Managing Director of Deepak Fertilizer. He's with us on the show now. Mr. Mehta, morning, and thanks so much for joining in. What led to the decline in margins this time? It's a very sharp decline that we've seen. Was it purely on account of raw material pressures? And what can you guide on margins going ahead for the first half of the year and the second half of the year?
Sure. So before I come to the Q4, let me just share the good news that the 12 month that preceded, we just finished our board meeting. We have had a jump on the top line of around 47%, and we crossed the landmark of 11,000 crores. So it's around 11,300. And even more in terms of profitability for the full year, we have had a 77% jump. And again, there we have crossed the landmark of 1,000 crores, 1,200 odd. So that's been the whole of last year. And just as a takeaway, if I might share,
right,
that one reason why this has happened, as we have seen last year, we had a lot of raw material price hikes, 60 to 80%, and that was passed through as finished product pricing. And finished product prices also saw a huge upswing last year. Now, despite the finished product prices going so high, in none of our three sectors, meaning the fertilizer sector, the mining chemicals, and the industrial chemicals, in none of the three sectors, we saw any demand destruction. And that is the biggest takeaway for us for the last year, that it validated this aspect that all our three sectors are beautifully aligned with the India growth story.
Right.
So now when it's coming to this, the Q4, what we were seeing was that there is a...
Mr. Mehta, we have the Q4 numbers. We actually, I think what my colleague was trying to ask you is the way forward. So, there was a decline in margins this time. We got that there could have perhaps been some pressure on raw material costs. But in the chemical segment, for example, do you expect further pressure in margins? And if yes, on an average, what could you clock in? I mean, from this, 16, 17% level that you're sitting on right now in terms of margins, could it get worse? Could it get better?
So what we are seeing, I was just explaining that the raw material prices from last year have started dropping down, and so also the finished product. And there could be a quarter or two where there is a bit of a mismatch. Otherwise, what we are seeing is it is happening in tandem, and we should be reverting back to our reasonable margins that were there in the pre-COVID days. So from that perspective, we seem to be in the right direction. As far as even the growth goes, what we are finding is for the mining chemicals, the coal mining is in a huge upswing. Cement and infrastructure we have seen in the government's budget, the allocations are only going up. So all those are positive signs. The most important is we are also working hard on now further enhancing our commodity to specialty strategies for all the three businesses. So that is also going to gradually help to enhance the margins.
Okay. Mr. Mehta, so, full year margins were about 19%, little over 19%. Would you want to guide us for 24? Where would they be?
So it would be a little speculative, but I can give you the broad directions that we are not seeing any gaps in terms of the demand. In fact, it's something that's only growing. The second is that some of our capacities, debottlenecking capacities will kick in. But more important, the major risk mitigation measure that is going to emerge is that our large ammonia investment, which is a raw material for all the three businesses, that as what we have planned by Q1, we should be able to commission the plant. And then the vagaries of ammonia are things that will be, behind us, because ammonia will be a part of the group.
Got it. Okay, so you're saying they should be 19, if not higher. That's what I'm hearing. Mr. Mehta, revenues went up. Of course, the growth was solid. Almost 50%, 23 over 22. Again, here, could you broadly give us a ballpark way of thinking about what growth will be in 24?
So again, like I said, if you look at the undercurrents, the demand that we see for each of our products are very healthy, particularly in terms of the mining sector, coal mining, I would say cement, limestone, and also infrastructure. Similarly, we are seeing that on the chemical front, acids and IP and all also are all in a decent kind of growth trajectory. So from a volume perspective, we don't expect any problems. Pricing, like I said, that there are vagaries emerging out of this raw material to finished product adjustment, which is a matter of a quarter or two, and it should settle down.
Okay. Just before we let you go, I just wanted an update on the demerger, because the street's focus is on that. In terms of a timeline, what are we looking at? And you have said in the past that you're looking to list the fertilizer and the TAN business separately. Any timelines that we are working with?
So the process of demerger, where each business will be now in a separate corporate entity, the chemical business, the mining chemicals, and the fertilizer crop nutrition business. And that demerger is going through its normal routine NCLT process. And we expect by June, July, the process to complete. Post that, we will be looking at, the requirements in terms of the growth, in terms of a lot of interest from strategic investors, depending on those triggers, we will consider the right time to list.
Got that. What's the absolute debt figure currently, sir?
So again, if one were to add the project debt or so, it could be around 3,500, 4,000 crores. And there, of course, one misnomer that I would always look at is the project debt is all accounted for in the project costs. So it is not going to hit the P&L. It is something where, only post those projects coming into operations and maybe a year or two of moratorium, that the interest and the repayment will start and it will hit the P&L. So right now, while the project debt is around 4,000 odd crores, it is not impacting the P&L as such, because it's all accounted for in the project.
Okay, all right. We'll let you go on that note.
Just one thing, Mr. Mehta, if I can just ask you, so top line growth, you did not give numbers, but you did say volume growth, there is a certainty. So could you tell us what kind of volume growth are you expecting both in the chemicals and fertilizer segments?
So why I'm not putting a figure is that, as prices come down, both raw material and finished product, putting a value to it would be again speculative. So in terms of volume part of it, we expect a similar good trend to continue.
Any numbers on the volume growth when you say similar trend?
Like the last year trends that are there. So we'll continue with that.
Okay, we'll leave it at that. Thanks a lot for joining in. Appreciate your thoughts, Mr. Mehta. That's the word coming in from Deepak Fertilisers, but we